For more on finance, I'm joined in Sydney by Tony Boyadjian, Senior Vice President for Foreign Exchange at Compass Markets. Good morning to you, Tony.
Good morning, Dale.
So as I mentioned, that unemployment data is due out today, and expectations are pretty high that it's going to be strong. Do you agree with this?
The market is forecasting a rise of another 20,000 jobs for the month of July, Del, and we'll find out at 11:30 a.m. today if that eventuates. It'll be the fifth consecutive monthly rise in the jobs number. And when we look at the jobs market in Australia, we've seen a creation of 115,000 full-time jobs just in the past 2 months. And it's quite robust, the jobs market. Unemployment rate in Australia is around that 5.6%. It's at 4-year lows. I mean, only 2 years ago, the unemployment rate in Australia was at 6.3%. So that alone has improved by 11% over that period of time. And that robust growth in full-time jobs is the strongest we've seen in 29 years. We expect that number to be quite strong today. It might not be as big as 20,000. It could be a little bit lower than that, but it should help support the Australian dollar because it's been the terms of trade and the trade surplus that has also helped the currency keep its head above water.
But Tony, as you said, it could potentially be the fifth consecutive month of strong jobs growth. While jobs growth is obviously a great sign for our economy, as I mentioned, wages growth is still at record lows, and this is surely a cause for concern for the RBA.
It certainly is, Adele. Wage growth index released yesterday showed that for the June quarter, it only rose by 0.5%. Annualised, the figure is 1.9%. It remains stubbornly low. This is one of the reasons why inflation remains low in Australia. Low rates means low inflation. The wage growth is a concern. It's one of the negatives in the economy, whereas employment is perhaps one of the positives. And that's certainly keeping the interest rate situation sidelined. The Reserve Bank maintains its neutral policy when it comes to interest rates, which means the chance of a rate hike is the same as a rate cut. It's a conundrum that the Reserve Bank of Australia has. They don't want to raise interest rates when households have record debt levels. They don't want to cut interest rates at the moment because they don't want to further stoke the property markets, especially in Victoria and New South Wales. So they're going to be sidelined, and we expect the Reserve Bank to be sidelined on interest rates still for at least another 12 months.
So Tony, quickly, before I let you go, the Australian dollar has tracked below 80 US cents. It's currently around 79 US cents, as I mentioned earlier. Can we expect it to stay below that 80 US cent mark?
Yeah, look, the Reserve Bank has jawboned the currency a little bit lower as well. They've said that a lower Australian dollar is preferred for maintaining Australia's international competitiveness, and that will continue to be the case. We expect the Aussie dollar to be in a 77 to 80 cent range. It's actually lifted by over 1% overnight after the US Federal Reserve announced some concerns about their inflation outlook and the fact that they may abstain from raising rates again this year. That potential has now fallen from as high as 50% a month ago to around 35%. So the US dollar upside being limited has helped the Aussie dollar back above 79 cents this morning, but we're expecting the Aussie dollar to remain in a 77 to 80 cent range short term.
All right, Tony Boyadjian, great talking to you. Thank you.
Thanks, Del.